Hey guys, TommyBryson here, and how exactly do you go ahead and invest into the S&P 500, which by the way stands for the Standard & Poor's Index, okay? Now by the way, the big thing is basically tell me, how do I invest into it? Which app do I actually use? What platform basically? How much do I invest? When do I invest? And how does the entire thing actually work? What is an index fund? What is an ETF? I'm gonna do my best to answer all these questions in this video in a very easy way to actually understand. The goal is not to complicate anything, so by this video, you should know exactly what all the things actually are and how to go ahead and buy into the S&P 500 index fund, or the ETF form. I break everything down in this video right here. Now, if you guys are new here, I post videos every single day, so you should also subscribe, hit the bell to get notified, and on top of that, also destroy the like button. And by the way, I have well over 100K invested into the S&P 500, and that's why I'm gonna break everything down in this video also. Now, the very first thing is, Tommy, what exactly is the S&P 500? The answer is, well, it started out back in 1923. It was known as the composite index. And the whole concept was back then, it only had 90 companies. However, in 1957, it expanded up to 500 companies, thus calling it the S&P 500 index, okay? Now, what exactly does it contain, Tommy? Well, in reality, it contains the 500 largest, biggest companies in America. That's the idea. Now, those 500 biggest companies, well, they're actually around 80% of the entire value of the entire US market. So whenever you go ahead and invest into the S&P 500, in reality, you're kind of investing into the whole US market as a whole by just investing into those 500 largest companies. They account for around 80% worth of the US market, okay? If you want to, you could buy the whole total exchange, where basically you buy every single thing in the US market, but the S&P 500 is just good enough also. So that's the one I actually use. I don't buy the total one with every single thing out there. More like, hey, what are the top 500 winners? And I'm gonna go ahead and buy into that right there. And by the way, guys, the S&P 500 makes around an average between 8 to 12%. Now, if you go on Google, it'll say 11% or 10%. But again, the more articles you read, the more books you read. Everyone has a different rate and different calculations. But my whole thing is basically, it's usually from 8 to 12% an average. Now, for example, if you had invested, let's say, for example, $1,000 every single month for the past 10 years at a 12% return into the S&P 500, in reality, today you will have somewhere around $235,000. And that's why they say, basically, the saying says, the best time to plant a tree was basically 25 years ago. So in reality, I see this to say, if you're going to invest, starting now is important, because 10 years from now, what you want to have is a lot of money and not basically a lot of regrets, okay? That's not what I want for you. Now, Tommy, how exactly can I go ahead and invest directly into the S&P 500 index? The answer is you can't. You just can't right now. However, though, what you can do is invest with a company that's basically created a fund to mirror that index, okay? And that's why they call it, hey, a company created a fund to mirror an index. What do they call that? They call that an index fund, right? Because that company created basically a fund where you actually buy into. And the whole purpose is to go ahead and basically try to mirror whatever index you actually want to mirror or track. So for example, although you can't buy directly into the whole S&P 500 index, what you can do is buy basically an index fund that's mirroring it, but to give you the exact same return by a little like fraction of an error margin here and there, but you're gonna get basically the exact same thing. Tommy, by the way, so everyone knows here, okay, an index fund is also a type of mutual fund. But the big difference is, for example, you're not trying to go ahead and beat the entire index or the whole market as a whole. All you're trying to do is mirror the market performance, okay? You're trying to mirror the entire index, and that's what we call it, for example, an index fund. And that's why the managers there, they barely do any work, okay? They're just trying to basically mirror everything. And because of that, you have a lower expense ratio. While, for example, basically what they actually charge you to actually be a part of it, while, for example, a mutual fund would charge you 1% or 2% because basically they're trying to go ahead and beat the market. Although, for example, the facts show over the past 50 to 75 years, index funds have outperformed mutual funds that are trying to beat the market, okay? So that's usually why I also invest into index funds. It's the only thing I invest into, not mutual funds or hedge funds whatsoever, but that's in a video for another day. Now, on top of that, you might not be remembering this, but in reality, you have, for example, index funds, mutual funds, and on top of that, even like ETFs. ETFs are exchange traded funds that can also track an index, okay? That's also pretty cool. ETFs are traded on the stock market, okay, on a live exchange. So they can also be based on fluctuation, not, for example, like index funds that are based basically on the NAV value, the net asset value, but that's another video for another day. And although you're watching this video right here and you want to know about basically the S&P 500, there are also other types of indexes out there. So for example, if you wanted to go ahead and track the entire technology space or the whole index as a whole, you can invest, for example, into VGT. And this right here is actually an ETF, which also has, for example, an index fund. Now, overall, okay, if you had put money into this whole thing, $10,000, for example, 10 years ago, that would have grown into around $64,000, almost 6 times your money. But why? Because basically, technology is flourishing right now. So my point is this. There are very, very different ETFs out there and index funds out there trying, for example, different indexes out there, okay? That's the idea. It's not just, for example, like, hey, just the S&P 500. No, there's also technology, real estate, bond market. There's a whole bunch of different indexes out there. And if you want to, you can track if you want to, okay? And by the way, the entire index fund format for this ETF right here, when you click right here on Vanguard, it shows you it's actually this right here, VITAX. It tracks the entire index for technology. The biggest holdings here are, for example, Apple, Microsoft, Nvidia, Visa, and so on and so on and so on. My point is basically, if you want to invest into index funds and you want to basically say, hey, I want to do tech, I want to do basically international companies, I want to do the bond market, the real estate market, there are a lot of different indexes out there, even mid cap, small cap, okay? It's not just, for example, the S&P 500 index, okay? Just keep that in mind there. Now, Tommy, I understand that, but how can I go in there, for example, and invest into the entire S&P 500 index fund, okay? What platforms do I actually use to go ahead and buy? Because, for example, Robinhood doesn't let me, and my finance doesn't let me. A lot of apps out there don't actually let me. Well, the answer is the top 3 dogs out there are going to be Vanguard, Fidelity, and Schwab's. Now, Vanguard invented the original index fund, so basically, they are ahead by a large margin. Everyone's trying to catch up in reality, and that's why other funds, for example, like Fidelity and the whole Schwab fund, they're willing to charge you less money, expense ratio, and also require no minimum deposit. But in reality, which one is going to be better? The answer is none of them are better. You know why? Because basically, they're all just trying to mirror something. It's not like one of them's going to do a better job. No, they're all just trying to mirror something. So in reality, whatever you get in one fund, usually you're going to get it in another fund and the next fund. It might be off by a little margin, but not off by that much, okay? So for example, if you wanted to go ahead and use Vanguard, well, in reality, the Vanguard one is called the Vanguard 500 Index Fund, Admiral shares, and the ticker symbol is VFIAX. Now, by the way, ticker symbols are ticker symbols that you actually use to find the fund you want to find very quickly, very fast, okay? And by the way, this right here, notice this, guys, okay? Expense ratio is 0.04, very low. On top of that, it does require a minimum investment of $3,000, okay? It's a lot of money. However, though, there is a way to bypass this, okay? If you're going to invest into index funds, just do it for your retirement fund, and this way, Vanguard will not ask you for this minimum investment. In reality, you can invest right away with whatever money you actually have if you're going to put this money, for example, into a retirement fund. That's the idea. For example, your 401k, Roth 401k, or any of that stuff out there. And again, if you invested $10,000, it would have turned into, for example, $37,000. Now, one big thing is this, okay? If you can't afford to to invest into this entire like index right here, because you want to do it in a taxable account, the answer is you can always invest directly into the ETF. Basically saying, hey, you can actually buy one share for a cheaper price. This right here is only around $385, but in reality, if you use M1 Finance or Robinhood or SoFi, I personally use M1 Finance. I love M1 Finance. The answer is you can invest with $10, not $3,000, or for example, just into a retirement account. So ETFs are a great way to track those indexes without having to worry, for example, about a minimum deposit or investment and all the other stuff. So in M1 Finance, I can have, for example, my Roth IRA, traditional IRA. In Vanguard, I can have, for example, my 401k or my Roth 401k. But this way, I have everything correctly. And on top of that, the whole Fidelity one is right here, and the entire ticker symbol right here is FX. AIX, okay? And by the way, again, it's the same exact thing. Look at this, $10,000 invested would have turned into $37,000. The exact same thing. It tells you right here, by the way, okay? It's the exact same thing. It's not that crazy. Difference is, for example, they only charge you 0.015. It's low, okay? It's pretty low. And then the Vanguard one is 0.04. You know, for perspective here, we're talking about fractions of pennies. It's really not that expensive. And on top of that, minimum investment is $0. That is a big thing. For most people out there, you might not have all the money that you actually need to go ahead and invest $2,000 directly with Vanguard. But keep in mind, this fund right here holds around $328 million, okay? A lot of money. The Schwab one is actually, the symbol is SWPPX. But again, it's the exact same thing. They're all just trying to track the same index. And this right here only has around $59 million in assets. Now, when you think about this, for example, the Vanguard one was the first one to actually get started. Meaning, for example, they have worth around $731 billion. Now, why do I personally use Vanguard? Because basically, I love the customer service. They're the oldest dog actually running the whole show, and I know exactly what they're doing. That's why I use Vanguard. Although Fidelity and Schwab's are gonna get you very similar results, it's not a big difference. Tommy, but this one right here is $300. Fidelity is like around $100 something. Schwab's like $96. Again, it's because how much money does she have into it, okay? That's the whole concept. It's not like one is worth more or less. No, it's the same exact thing. They're trying to mirror something, but I choose to actually invest into Vanguard because basically I trust the company more. And John C. Bogle, the creator of the whole index thing, actually taught me everything I know. And that's basically why I use Vanguard also. It's a great company overall, but only for my retirement. And honestly, I'll say this last thing here, guys, okay? So far, you know exactly what an index fund is, what this S&P 500 actually is, how it works, how to invest into it. You know everything you actually need to know to start right now investing directly into it. And how you make an account is basically, you go to the website and you click create an account. However, though, guys, okay, this space of index fund investors, when it comes, for example, into Vanguard, Fidelity, and Schwab's, they are very outdated when it comes to their entire platforms. One thing I wish is, for example, they would actually go in and change everything up to make it look, for example, a lot like modern apps out there, like M1 Finance especially, okay? That way, you can invest automatically, you can basically rebalance automatically, and everything is easier. But for right now, the spaces are a little outdated, but in the future, I think they'll basically improve and so on and so on. Now, last question is, Tommy, how much money should I invest? Well, in reality, I would say once you're debt-free and have a full emergency fund, you can go ahead and invest between 10 to 20% into your retirement funds. However, though, I would not put all my money into the S&P 500, although it is the American market. Why? Because America is not always going to be the best market. So me personally, this right here is only around 38% of my portfolio. The S&P 500 is only 38% of my portfolio. And then, for example, the other 62% is into 6 different index funds out there. Now, if you want to know exactly what I invest into, I have a full video linked down below on my full guide to invest in the stock market, okay? And by the way, this is free, and it's also on YouTube, linked down below. Watch that video, and it'll help you out a lot on how to diversify to make sure you don't carry that much risk. But again, there are no favorites. There's not a better company out there. They're all really just trying to basically track the whole index as a whole, okay? Keep that in mind. But when it comes to mutual funds, They might be different, okay? Keep that in mind, but that's another video for another day. I'll see you guys tomorrow. Thanks for watching. As always, like, subscribe, hit the bell, stay notified, and comment down below and let me know, did this video make sense? Do you actually understand it, okay? That's what I want to know. If you don't, comment down below, let me know, and I'll answer your questions directly as fast as possible, okay, guys? On top of that, as always, like, subscribe, hit the bell, stay notified. And if you guys want to talk to me directly, well, join me on my third channel. It's called Ask TommyBryson, where I take calls for 30 minutes. All calls are free, by the way, but again, they are limited, so get what you still can. And on top of that, last, if you want to DM me right here at TommyBryson on Instagram. Thanks for watching, guys. Another video right here on basically how to invest, and also my face right here. Click here. See you guys tomorrow, and as always, peace.